It's been another strong set of results for Impact. Could you talk us through the key highlights of the year?
I think if you ask me to pick one highlight, it's been the continued level of resilience our business has shown, not just through 2021, but throughout the pandemic. And it's that resilience which has really underpinned the financial and operating results we're reporting on now for 2021. I think we all hope we're finally exiting the pandemic, but we're facing new challenges now: rising interest rates, rising inflation, and the challenges of the tragedy of a major war in Europe. Our job in this very uncertain world is to focus on the essence of our business. And in our minds, the essence is forming long-term partnerships with our tenants, working together with them to deliver vital social care infrastructure for some of the most vulnerable people in society. And if we're successful at doing that, we should then be successful in delivering long-term sustainable returns for our shareholders in the form of income and capital gains. So what does resilience mean in practice? I point to three things. So first, our buildings are all occupied. We have zero voids. Second, rent collection. Since inception, we have collected 100% of rent due, and that's continued through the pandemic. And third, our tenants are profitable. So in 2021, their rent cover was 1.9 times, which is slightly higher than it was before the pandemic.
And what about the key financial metrics of the year?
We're very pleased with the numbers we published for 2021. So we delivered solid growth during the year. Our rent roll at the end of the year, contracted rent, was £38 million, up 23% on the prior year. At the end of the year, we owned 124 operational care homes with 6,720 beds. So to put that in some perspective, we own about 1.5% of a very fragmented market. And that gives us confidence we can go on growing the business in a selective, disciplined way. Our profits were up 11% on the previous year. We increased our dividend we paid by 2% to 6.41p a share. And importantly, those dividends were fully covered by earnings, so 126% covered by EPRA earnings per share. One final number, our target is to deliver long-term sustainable income with some capital gains while maintaining a conservative balance sheet. Our loan to value at the end of the year was 22%, and we reduced that post-year end from proceeds of the equity raise we did in February 2022.
You mentioned inflation. How do you expect it to affect the business going forwards?
It's clearly going to be the big thing to worry about in 2022. And when we set up the business, we built inflation protection. We thought about it actually from the beginning. We built protection against inflation in several different layers. So the first layer is in our leases. So 100% of our leases have annual rent reviews linked to inflation. Second layer is at the tenant level. So I've mentioned this already, but what our tenants do is they provide an essential service, which is non-discretionary. So if I put that in simpler words, when someone needs care, they really need care. And one way or another, that care has to be paid for. We get very, very detailed monthly and quarterly reporting from our tenants, so we can track at home level what they're spending on inputs like electricity, gas, water, or food. So in 2021, our tenants spent an average of 2.1% of the revenues on electricity and gas and 3.6% on food. So if the cost for those inputs goes up by 25%, it will reduce our tenants' margins by about 1%, just over 1%, if they can't pass those cost increases on to their residents. So it has an impact, but it's not that material. A final thought on inflation, I think something probably we can all agree on, is it would be good and desirable if care workers were better paid. And in our experience is when users of care, people paying for care, if they have explained to them, we're going to increase the cost of the care, but that additional resources are going to be used to pay staff better and improve staff conditions, most people welcome that.
How has COVID changed your business, and what impact do you expect it to have going forwards?
It's clearly premature to give a definitive answer to that question. So while we all hope we're exiting a pandemic, it's not completely over yet. But I think what we're seeing, we'd suggest there are three major trends which the pandemic has accelerated. So the most significant of those is the pandemic threw a really clear spotlight on how important care homes are as critical social infrastructure for the fastest growing part of the UK population, which is people over 85. Now, you might argue it's belated, but belatedly, this has forced the government to introduce some major package reforms for elderly care, which they did at the end of last year. Reforms aimed at increasing funding, increasing access to care, making it fairer, and hopefully increasing the quality of care. Now, are those reforms complete? Are they perfect? Of course not. They'll never be complete or perfect, I don't think. But we welcome them, and we think they're a major step forwards in the right direction. So the second trend we're starting to see is we're having some very interesting conversations with tenants and some of our other partners about what have we learned from the pandemic, particularly with regards to the built environment. So some of those conversations are quite short-term about how could infection control be improved, how could we manage buildings differently, build them in a slightly different way. I think the more interesting conversation from our point of view is about the medium, longer term of how could we develop a better built environment for people living with dementia. And the third trend, I think the pandemic taught everyone across society about the risks of relying on paper-based management systems. So we think it's going to accelerate potentially quite quickly the move from paper-based healthcare management to digital online systems. Now, we don't think that necessarily will mean big changes in the buildings and what the buildings look like, but we think potentially will have a major positive impact on the quality and transparency of care, which will benefit all stakeholders, including us, the landlord.
Are asset management initiatives and the pre-let development of new properties a growing part of your value creation strategy?
Asset management has been an important part of what we do in our value creation strategy from day one. And yes, we are looking at ways of being more ambitious in this area. So what do we mean by asset management? It's where we take an existing care home, extend it. For example, in 3-4 cases, we've extended it by building a dedicated dementia facility next to an existing care home. And if well done, we think this is a win-win-win. So from the residents' point of view, they get spacious, modern bedrooms, bathrooms, public areas to live in. The staff get better staff areas, kitchens, laundries, staff rooms, training areas. We can enhance the environmental performance of buildings by retrofitting PV on the roof, rainwater collection, wastewater collection. And we as a landlord end up with a larger, modernised building paying more rent with potential for capital appreciation. We've currently got 2 new homes coming out of the ground. We're forward funding the development of them. And we're very glad that last year Simon Gould joined our team in August last year from another major UK healthcare REIT, where he'd spent 14 years developing primary care centres. And he's going to lead our effort in thinking through how we step up on this and become more ambitious.
It looks to me as though Impact Healthcare is in a strong position to deliver on its long-term growth strategy. But what could go wrong?
Good question. Something we're not losing sleep at night, but we spend a lot of time thinking about. So we've talked about inflation. That's obviously going to be the main creator of stress during 2022 and why we think we've built in several layers of protection against that. I think the best way we can stop things from going wrong is not to lose sight of the fact that we're running a clear and relatively simple business. And as I've said before, and I'm going to repeat myself, at the heart of that is a long-term partnership with our tenants. So if our tenants go on being successful, our rent will be paid. If our rent is paid, we'll be able to pay our dividends on a fully covered basis to our shareholders, despite whatever terrible news we're reading in the headlines.